In this video, I'd like to share with you the sources of funds that you can utilise to acquire your properties. Before we actually look at where you can tap into the individual elements, let's cover some of the basics first. First off, there's definitely more money out there than there is deals. And typically when I work with investors and we look at all the options open to them, we can untap into excess supply that they weren't aware of. Secondly, when you're looking to source funds, I firmly believe you want to run out of your own funds first. And you want to do that because that's normally going to be the cheapest debt that you can get. It's normally sitting in your bank account, earning very little. Obviously, you need to make sure you maintain a buffer for your personal life and also for your business. But anything above that, you should be using your funds before going to a third party. Next, you want to consider the aggregate cost of debt across your portfolio. And common sense tells you want to take products with the cheapest rate available for you. And that's what you will do in the majority of cases. However, like most things in life, it's not black and white, there's different greys and different colours in between. So sometimes you may take a dearer rate because you may have an investor that you want to keep happy and you want to keep recycling their cash. So to do that, to make sure you have a long-term relationship, you may be prepared to pay a slightly dearer rate. You may also need to complete something on speed, and certain lenders will take significant time. You may have to go to a slightly dearer product based on that. And finally, depending on where you are in your journey, if cash flow is a driver for you and certain lenders will only provide you capital and interest repayment mortgages compared to others who just do interest only, you may have to choose the one that does interest only. So recommendation is look to get the aggregate rate as low as you can, but consider the other factors as well. Okay, so when we talk about sources of funds, as I say, the key thing is to start with the ones that are typically going to provide you the lowest rate of interest. So if you're lucky, you've got some savings in the bank. Again, you can use that for your full deposit or part towards your deposit. Second cheapest rate typically available to you is the equity in your own house. You can get mortgage rates for your own house, sub 2%. It really is very cheap money now. You don't have to do very well in property to beat a 2% yield. Even prime London typically will give you higher than a 2% yield return. Second area of property is if you've already got some buy-to-lets or some investment properties, and if they've performed well during a time period, you may have additional equity that you can tap into there. Typically in buy-to-let mortgages, to kind of HMOs, to commercials, you'll be paying anything between 3% up to 6.5% at the top rate. So again, tapping into your own equity from investments, you should be able to get a far better return with a new property purchase. A lot of us have companies, and if they're performing well, they've got profits, costs, tax implications to take the money out of the company. So why not use your retained profits within your company towards purchasing investment properties? Pension schemes have grown hugely over the last 4 or 5 years, particularly the SAS pension schemes, and I'll do a video later on about how I've used that. But a lot of investors have come to the realization that they can transfer existing pension schemes into a SAS pension scheme and they can utilize the funds from that. You have to get proper financial advice on this and you have to work with specialists for it, but it's a great way to use your own money that you may not have access to until you're at least 55 and use that now and get better returns on property. Also, the great thing about SAS pension schemes is though the rules of it means that you can basically use about 50% of the scheme for your own products and projects, and then you can use 50% of the scheme to lend to other investors. So working with other investors who've got SaaS pension schemes, they typically want to lend that money out. So that can be another great source of funds available to you. Crowdfunding has exploded over the last couple of years. It's one of the really kind of innovative new ways for raising finance for property purchases and other business purchases and just retail purchases. What I would say about crowdfunding is you really want to work with someone who's a specialist in the property market, who's got a track record, to make sure that you know that you're going to get the funds when you've been told that you get them. You can also use creative strategies at the appropriate time with buyers. So if buyers don't actually need the full cash price for their purchase now, and that may be for a number of reasons. It may be that they simply don't want it and you can potentially give them a better return. It may be that they've got actual tax implications on it. It may be that you'll pay them more money at a later date. So if you use strategies such as lease options, whereby you acquire a property on an option agreement where you agree to pay a monthly lease to the owner, and then you have the option to acquire that property at a future date. Similarly, an exchange and delayed completion is when you exchange on a property immediately, but you delay the completion for 1 year, 5 years, 10 years. And I've used that strategy a number of times in the last couple of years. I might add for each time I've used it, it's been in the seller's interests rather than mine. Won't work in every case, but for certain cases it works well for the seller. Unfortunately, at one point you will run out of money, so ultimately you do have to earn more money to pay towards it. You can do that in a number of ways. You may do it by actually selling off properties, realising the gain. You may do it by doing flip deals to give you a profit so that you can then put that into buy to hold. You may simply have to work harder in your day job, get a better job. You can also look at how much money you're spending, and is there ways to actually cut costs, and I'll talk a bit more about that when I go through top tips.